Dollars and Cents with HAPO Community Credit Union helps empower our listeners to achieve financial success while living for today and planning for tomorrow. This podcast focuses on financial education, community support, fraud prevention, real-life stories of financial transformation, and much more. HAPO Community Credit Union serves Washington and Oregon with over 18 locations. Bank on more when you bank with us.
Hi, everybody, and welcome back to another episode of Dollars and Cents, HAPO Community Credit Union's financial literacy podcast. Today in the studio, I've got Britany and Carol, two loan officers with HAPO Mortgage. We're going to be talking about the current landscape of mortgage out in this world right now. We're going to touch on a kind of a touchy subject, high rates, how to navigate those, what's going on with that, and who knows where else the conversation is going to take us. Ladies, welcome.
Thank you. Thanks for having us.
Oh, our pleasure. So let's get started right out of the gate. What does everything out there look like? We'll avoid the rates conversation for the moment, but I guarantee we'll get there soon enough.
Well, without talking about rates, inflation is still a huge topic. And so that's kind of been driving the Fed and, their decision to cut rates. And, it's a day by day scenario. I think with some of the reports that come out on a weekly basis or daily basis is what determines whether they're going to, in the future, cut rates. Right now, they've kind of held off on it for the last few months. And so that's really kept us steady at the rates that we're at right now. So I think right now, a lot of people are getting comfortable with the rates. Whereas, maybe a few months ago, they weren't so comfortable seeing that the rates were a little bit higher, but historically they're still low compared to the way they were.
I think a lot of people don't understand like the roller coaster that rates in general have been on over the last couple of decades.
Correct.
I know that I got really lucky where mine is at probably one of the lowest that we've seen in a long time. But how does that impact people with, say, the prices in housing markets as well being pretty much, if I'm not mistaken, at quite a bit of a higher rate than they've been previously?
Well, I know that one thing that I have seen, in the last 5 years or so is the values of the homes, especially here in Tri-Cities, they've been very steadily going up. And I think what happened, pre-COVID was the values were going up. There was, you could, make offers. There was multiple offers on homes that were for sale. And so what started happening is that started increasing the values of the home faster than what we were comfortable with, I think. And so when COVID hit, they decided to lower the rates to kind of keep everything moving and the housing market moving. And so I don't know that we'll ever see rates that low again, because that was truly an exception for a time, that there was other things happening. We're going through a pandemic. And so they were trying to keep the market going. And so I think with rates that low at that time, a lot of people refinanced. And so after that, the rates started going up, inflation was going up. And so the Fed decided that they were going to start increasing the rates to kind of slow down the market because things had gotten so, expensive. And there was, you could make an offer on a home and there was 10 other offers and they were bidding for higher than what the people were selling their homes for.
Yeah, I do definitely remember that environment being out there where people are like, I put my house on the market at $250,000 and I closed in, I had an accepted offer within a week for $50,000 over asking price. Right. Like, wow, what is going on here? Right. Why don't I have a house to sell?
Right. And so,
we've been hit on both sides with the rates going up and the house prices increasing at the same time. It's in this area, it's made it even harder for people to be able to qualify right now. And so you do have to do more planning up front in order to be able to to make it work these days.
And of course, this is a big financial decision. So planning is pretty much what we want people to be doing.
Absolutely.
On previous episode, we had a couple of people in, and I chatted with them about what they want out of a member that's coming to them to get a loan. I was asking, do you want them to go out and find a house that they're interested in first, or do they want to come talk to you first? And hands down, it was come talk to your loan officer first, get a pre-approval, know what range you're looking at. Because the last thing you want is to go out and be like, I found this beautiful house for $600,000 and find out you're only approved for $350,000.
Yep.
Well, especially if you have, and that's completely 100% right. We have to look at your specific scenario. What's your income? What's your credit? How much down payment do you have? And then, a lot of people, especially if they're first-time home buyers, they're not aware of what the mortgage payment consists of. So you have, your principal, interest, taxes, insurance, mortgage insurance, HOA fees. So there's additional costs to owning a home than just let me get a loan and let me buy a house. And those are the things that we can help them navigate.
Yeah, there's a number of things when I first got into my first house that I got to kind of slide around. My original first home was my grandfather's, and I took it over while he went into nursing care. But it was a family loan type of a situation, and I got a really weird scenario when I walked into that one. But then I went and got my first actual mortgage, and whoo boy,
check.
yeah, just a little bit different. Went through a refinance for some home improvement work that we wanted to do. So did some equity stuff. So I've been through it a couple of times at this point. But yeah, everything has definitely changed since I went through those two things. The insurance and the taxes, I think, were an interesting one for me, looking at those right out of the gate.
And that, with the increase in values, the counties are also increasing
Property
values, property taxes. And so that's been a big impact on what they can qualify for.
And homeowners insurance. We've seen large increases because the homeowners insurance companies don't have enough in reserves to cover the claims. So people's policies are doubling. So that is making a big impact.
I was going to say, with the value of a home, with the value of a home being much more, that insurance policy should not shockingly also go up, because you're now covering more value.
Right.
Like the house itself hasn't changed any, but the price to repair it or replace it definitely has.
And, I think one of the most common things that we see, and we were talking about this, is like with first-time home buyers, is like having, them be aware of what they can qualify for, because, the interest rate does affect your payment. And so when we're sitting there calculating, a lot of it is some financial counseling and getting them prepared for that payment, but also for them to be aware that, this dollar amount, this is what your payment's going to be. Are you comfortable with that? And then they see that and they're like, no, I don't want to pay that much. Then we have to go, either scale back or get ready for that.
Yeah.
That's a conversation I just had with an employee here the other day it was a shock to her when I told her what the payment was going to be. But we had a really good conversation about her being able to, over the next 6 months, in order to prepare for her down payment, she basically was going to start putting away the amount of that monthly payment we talked about each month, so that she could see what it felt like in order to be able to pay that payment each month. But she was also accomplishing the goal of being able to meet that down payment at the same time.
That's a fantastic budgeting maneuver for anybody that's looking into to getting into something. Having a conversation, finding out what that monthly dollar amount's going to feel like, not just look like, not just looking at that number and being like, yeah, sure, that's what a house costs, but to actually pull that from what you're working with, as well as then to put it aside and start to build up that down payment. Which, of course, if you do that long enough and you're lazy and you forget to actually pull the trigger, now suddenly you have a massive amount of money put aside for a down payment,
right?
Which could then effectively lower that monthly cost that you're looking at.
Also, the thing is we were talking about this earlier, was that people don't consider as a first-time home buyer, typically they don't have a washer and dryer, they don't have a refrigerator, they don't have the lawnmower and everything else that you need to be able to maintain a house. And so all of those expenses are additional things that they don't consider when they're moving in. And a lot of people end up having to get a credit card to be able to cover those things. And now you've added another payment that has to be factored in as well. And
Do you get the borrowers that call you like a week or two before closing and say, can I go get my refrigerator and my sofas?
No, you cannot.
That's a really common one. It's like they start to think like, I'm going to need this, I'm going to need that. And and it's like, that there's a lot more expense to it than just, I'm going to go buy the house.
Well, and it's possible that when the house that you're looking at, they might opt to leave behind the appliances that were there, which is great because you don't have to go out and get them. But what you don't know is the state of those appliances as far as additions that you might be picking up. I know for me with the house that I moved into with my real mortgage, we'll call it that for now. I did actually get lucky and have they left behind the refrigerator and the washer and dryer, and within the first 2 months, the washing machine broke.
Oh,
and it. Just that's the type of thing that happens. It was older appliances, which was perfectly fine. But yeah, we had those type of things where, okay, now I need to go out and do this. And I didn't plan for it because it was something that was in the house. They also left me a pool table because I think it was too heavy for them to move.
Well, also with new construction, with new construction, they sometimes they don't put the fence, they don't do the backyard, they don't do certain things, rain gutters, sprinklers, and so
it adds up.
Oh yeah,
it really does. Yeah.
And then sprinklers are something that is just a joy in and of itself. Since we're just hitting spring and summer, I have gone through the standard homeowner re-upping my sprinkler system. I replaced almost an entire line of those.
Rent a trencher. That's a lesson my husband learned, was that you using a shovel doesn't get you very far.
It will. It just won't get you there as quickly.
Right.
Luckily, I didn't have to go down to that level. I was only swapping out sprinkler heads. But again, that's like outside of the range of talking about a mortgage, but home ownership, that is another one of those things that oftentimes people don't immediately think about, is like, oh, I have to adult much more than just having a place to live. I have to adult in a manner where I have to maintain and upgrade and deal with all of those situations of having a house.
And even with all of that, I would still encourage those that are not homeowners to go and look and see what they qualify for, because that is still the best investment you're ever going to make.
Oh, absolutely.
Right. And so even right now, what we're seeing is there's not as many offers on homes. Homes are on the market a little bit longer. And so they have some, the sellers are offering some incentives. Okay. I know builders are offering incentives on closing costs. And so, they're able to maybe drop the price, maybe give them those incentives. And so it's still a good time to buy, even with the rate. I mean, we have this saying, it's kind of been around for the last year or so, but marry the house, date the rate.
Yep.
Because you want to make that investment as soon as you can, because that's going to build you wealth. But the rate you can always refinance. On average, I'd say, I was looking at some statistics that say that most people will refinance at the 7-year mark. So, even if you bought a home now and the rate's a little bit higher than you're comfortable with, buy the home, because you're going to get a better price for it now versus waiting, 6 months or a year when the rates drop and those values are higher.
So and then you've also got more competition because everybody else is waiting for that time frame to get out there. Yeah. But that marry the house, date the rate, I like that phrasing, because the odds of you being in a home longer than you're going to be at that rate that you bought the home at is pretty high. I know the house that I'm currently in, I believe we've been there for 8 years now. And it's the house before that, I think we were there for 11. So if we're talking the 7-year mark is the refinance, I may have pulled the trigger on my refinance a little earlier, but it was a really good move.
Yeah. Right. Because that in rate environment, that really low rate environment was, that was just not normal. And so a lot of people took advantage of that. So those people that refinanced during that 2020, 2021, are the ones that are holding on to those homes unless they have some kind of life change that, forces them into having to refinance or sell. You're going to see that there's a group of people that don't really want to let go of that low interest
They're kind
rate.
of stuck on that a little bit, that's what they've seen now. So they don't understand that wasn't the norm. And
We got a little spoiled.
Yes. And so getting people that have not even bought a house and didn't get that interest rate, they've heard about those interest rates. And so that is what they feel like they're targeting. And so they feel like they're not going to move forward until we get to that point again, and getting people to understand that we're probably never going to get to that point again. Like you said, pull the trigger and start building that investment.
Unless we have another pandemic.
Yeah. And then if rates do drop, then obviously you've got an eye on those to refinance, to do those things. And of course, refinancing can come with some other things. I know when we did ours, we actually did a cash out refinance, which allowed us to grab some money too. And we used it as effectively a consolidation loan. We paid off a bunch of other higher interest debt and basically rolled that into our mortgage, with basically just pulling that equity out of the home on the refi and paying off those other loans. I think we paid off a car and some other loans that were probably sitting at like the 11% interest, something along those lines.
And refinance still makes sense today. Even with the rates the way they are, it still makes sense for certain situations. For example, one that, it's more common than people want to talk about, but divorce. In divorce situations, that one keeps the house, the other one wants their share of the equity. So the one that keeps the home has to refinance to remove the other one off the property and the deed. And so, and in order to cash them out, they have to refinance. So in that situation, there's no other option but to refinance. And sometimes, if they have high interest debt that is way higher than what they would get if they were to refinance, that makes sense. Yeah. And, we'll calculate those numbers for them. I've done it before where, we'll look at all their debt. What are your rates? What are you paying on that specific debt? Yeah, and what would it look like on the refi?
Because the rate might not look great to you when you compare what you've got to what you could end up with. Right. But if you're looking at rolling all of that other higher interest debt, like if you're running a high interest credit card and you're putting everything on that, you have a rolling balance with that, being able to pull that, because some of those can get up to the mid to upper 20% range as far as those rolling balances. Yeah. Yep. Being able to pull that down to a 7% range. Wow. You're talking 25% of the interest rate at that point, just gone.
Yeah, the rate. And then you're also looking at their minimum payment. So if they have all this debt and if you add up their minimum payment, sometimes that's way more, maybe double than if they were just to refinance and have one payment.
And if they can pull that, what they were paying towards those credit cards, and put it back towards the mortgage, they're going to decrease the amount of time that they have that loan anyway and save themselves on the interest if they can do that. But a lot of people want to take that savings and be able to live more comfortably when they do that refinance. But
they could always do a 10-year, 15-year term, 20-year term. You don't have to go back to a 30-year.
Yeah. I was saying the interesting thing to me is I was thinking about this on interest rate percentages and whatnot, but the number of payments that you're making, those minimum payments, requiring cash out monthly to those things, that's a part of that I hadn't considered previously. If I've got 8 different debts that all have a minimum payment, you can't get around it. If you can lump those all down into 2 or 3, then, you can probably pull down the amount of payments that you have to make each month, as well as that minimum payment, so that you can make more progress on different aspects.
I just had a client or a member who I helped. I've helped her a couple of times over the years, but she came to me just in tears a couple months ago, and she was like, "I don't sleep at night. I have so much debt." Her son had gotten himself into some trouble, and so she had helped and to the point where she was $100,000 in debt. And her husband was like, "We need to do something." And so she came in, we crunched the numbers for her, and, her monthly payments, they went down significantly to the point where she was just like, she messaged me the next day and she's like, "This is the first good night's rest I've had in months. Like, this is going to save my marriage. This is going to save my life, to that point where, it's like, before you get all, to that point, like, talk to a financial advisor, talk to your mortgage loan officer. If you have a home, like, you could always pull, some equity out of that home and do some, equity loans right now.
Well, and even if you're not in a situation where you can leverage something like that, we've had episodes with our certified financial coaches on before. Always worthwhile to, if you have any questions, come in, make an appointment with the certified financial coaches. Those are free appointments for members and non-members. Come in. They are more than happy to take a look at your financial situation and assist with what you can do to kind of wrangle that to get it under control. And again, the first
that's a
good
great
night's
service
sleep.
that HAPO has.
Oh, absolutely.
Yeah, it is.
Yeah. Being able to say that I had a financial conversation that led to a better night's sleep is, I think, more impactful to a lot of people listening than like the amount of debt that person may have had. Like the fact that this impacted probably their health.
Right.
Along with their relationships and everything else, being able to look at a thing like that and be like, oh, well, maybe I don't really like the rate that much, but my mental health and physical health are kind of
important.
Yeah.
Well, and maxed out credit cards are something that obviously affect your credit score as well. So getting those to be paid off and zero balance is going to help your credit overall as well. So there's a lot of benefits to being able to be able to get
trying to remember off the top of my head. I think you want to be somewhere around 30% of your total credit usage as far as your credit score is concerned. Now, anybody listening, don't quote me on that. I'm spitballing this off the top of my head, but there are additional, much like the financial coaches, we have a number of other tools that you can use that are much more accurate than listening to me. Like Savvy Money, I believe is one of those free services that we have that can give you some information on that, and like making on-time payments, how big of an impact that can make on your credit score. And of course, then if you've got all those things under control, your credit score is going to put you in a much better position when you start looking at rates for things like car loans and mortgages and refis. Say I have a project coming up that I want to do on my house. I've got a decent amount of equity in there and I have a ridiculously nice rate at the moment. I don't want to refi that. What can I do to avoid those current rates? Because for me, it probably doesn't make sense.
You don't have to. That's the good news.
Hooray!
Just going back to debt consolidation, same thing, and home improvements, you have home equity options. So basically keeping or doing a loan that's completely separate from your existing mortgage. Home equity fixed or a home equity line of credit basically are the two that you can choose from here at HAPO. So if you're doing projects, I would probably suggest, if you're doing them over time, the home equity line of credit is a great option because you can take the money as you need it and only pay interest on the balance that you have there, versus our home equity fixed option, you have to take it all at once with the amount that you're approved for. And if it's going to take a few months to be able to get things done, then you're still paying interest on that amount, even though you haven't used it yet.
So if we're looking at, say, a number of different around the house projects, we're going to be replacing cabinets or building shelving, and we've got a half dozen different projects that we're looking at, line of credit's probably going to be a better one. Head down to your local hardware store, buy the materials that you need if you're doing it yourself, or hire somebody and then a different somebody and then a different somebody for each of the different projects. But if, say, we're installing a swimming pool, which is going to be a big cost right out front,
and you know how much it is, you have a bid for it, you can do the fixed. The big difference between the two for most people, if I say variable on the interest rate, that is going to be either a go or a no-go for somebody on which way they're going with that. So the HELOC, I typically will ask the question as far as what it is that you're using those funds for, because people can be flexible if they do understand the benefit of having that flexibility and that line of credit that's available to you for emergencies as well. So even if you're only going to be spending $50,000 on those projects, maybe we get you a limit that's up to $100,000 to keep your balance under 50% of what the limit is, because it is a line of credit. 30%. Well, there's definitely different numbers there when it comes to that. But that being there to where if you had something come up that you didn't plan for, you can pull from that again for up to 10 years on the line of credit.
So remodeling my kitchen, I find out that there's, damage to the floorboards, some water damage. That's going to be a much bigger project than I would ever want to take on.
You're steering away from putting that back on credit cards. So if that was the goal when you came in, so even if you did have a few credit cards that we could wrap into that line of credit at the beginning, plus get those projects done, you can do all of that in one. So it's not one or the other for usage. So
and of course that's again not refinancing the entire thing to pull cash out. With a refinance, there's both cash out and non-cash out where you can just refinance. Where like I like this new rate, I would like to refinance and get myself at that rate. And then there's also, I would like to refinance and pull some equity out of here for a project if refinance was what looked like a good idea.
The other thing is the cost. So home equities come at a very minimal cost to do versus a refinance. Refinance typically is going to require an appraisal. There are those one-offs that you can get waivers on those, but even an appraisal costs to up to $1,000. And then you have all the other origination and other costs that go into a refinance, which again, it's worth it in the right scenario. And we can calculate those things for you. But if we're looking at, you have a 3% interest rate and you're wanting this project done now, we'll get you the rate that's available today. And then maybe in a couple of years, the rates go back down to the 4% range. We can also look at combining those and putting those back into one loan at one point. And then you're not paying full closing costs twice to be able to get you the money that you need. So home equities are very popular right now with the rate environment, with those people who do not want to touch that 3% mortgage that they have.
Well, I had a borrower who I thought this was a fantastic idea. They decided, they came last summer and they said, we want to buy a new house. They have their house owned free and clear. And they're like, we're going to upgrade. We've been in this house for so long. So I got them pre-approved. They were looking. And they happened to go to Mexico in December and were like, took a 2-week vacation, came back and said, we're not going to buy a new house. We want to buy a condo in Puerto Vallarta. So we did a home equity line of credit for them. And they're in Mexico right now.
In the condo on vacation.
Well, there we go. I'm going to say vacation. So obviously they're not looking for a primary residence at that point. Does that change what they're getting as far as the, like you said that they were doing a home equity line?
Equity on their current home. So their home is owned free and clear. So we focus on that property. So that property is, what the loan is on and, what they do with that money. Obviously we will ask, like, what is that money going to be used for? But you can use it pretty much for anything you want to.
I just did a home equity for a guy who didn't own his home free and clear, but he had enough equity available, and we were going to go through with a purchase, but closing costs on a purchase are more expensive. And using his primary residence, he was buying a property over in Idaho as a second home. They go over there on the weekends, and it was only $130,000. So he basically took the equity out of his existing property to pay the full amount on that property over there, and he didn't have to come in with the 10% down that's required for a second home. We were able to get him the full amount to be able to cover that cost in a second, which you're looking at a 10 or a 15-year term on it. So you do need to take a look at payments to make sure it makes sense for them in their financial situation, because sometimes that 30-year mortgage is going to be the only route if their debt to income ratio is an issue.
Yeah.
Okay. And then just back to my first comment on that one. So if they were to have gone through with getting a loan to upgrade to a new home, that would have been a primary residence type of a mortgage. Whereas the other scenario was buying a secondary home, which is two different mortgages, correct?
Yes, and two different requirements for down payment. So you can, if they're going into it as a primary residence, the down payment requirements, depending on the loan program, anywhere from 3.5% to 5%. And then with a second home or an investment property, you're looking anywhere from 10 to 20% down required on additional residences.
And so if somebody was looking at buying a property for, say, using it to rent out, that would be an investment property.
Correct.
Right.
Yep. That's going to require the higher down payment because it's for business purposes, basically. You're making income off of it. And so there's a higher risk. You're not going to make that payment first if you get into a financial situation where that renter moves out and you have to cover that payment. that's basically, we're counting on you being able to cover those additional expenses. And so they want a little bit more of a down payment to cover the lender in that situation.
Okay.
So here's the other scenario that I'm seeing around the purchases and investments is there's a lot of people that don't want to let go of that lower interest rate, right? And so they're keeping those home as investment properties, and they still want to upgrade and buy another home. So they asked me, like, what can we do? We want to keep this. It's going to be a rental. What would you require? And it's like, well, we want, as a lender, we're going to want a 12-month lease agreement to show that you're going to be renting it and that you're going to be receiving income on that property, that you're the departing residents. And so we can use that rental income in most cases to offset the payment. And that way that doesn't affect their debt to income ratios when they're trying to apply for the new home.
Interesting. Mm-hmm. That's a fun fact that I was unaware of.
Uh-huh.
Yep.
I did have another kind of topic I wanted to kind of circle back to. You mentioned about kind of the requirement in the situation of a divorce where somebody might have to refinance because they want to keep the property. I was thinking about that as we were talking, and other things where people might be required to be diving in and they don't really have the option of waiting for a better rate. We talked about how it's a really good moment to jump in, get the house, or marry the house, as we said. But what are other situations out there where somebody might really not have an option out when they're looking at things like that? The first one that came to my mind was relocating for, say, work, a new job opposite side of the country. Literally my neighbor in the last month relocated to, I believe they said Washington, D.C.
It's a big move.
Yeah, from one Washington to the other.
You may not want to keep that house here as an investment in that situation because you're not close enough to be able to handle things if something goes wrong with it. There are companies you can hire to be able to help with property that kind of thing, but some people have an issue with that, not being able to see what's going on with their home. So,
and I'm 90% certain that particular house is on the market now. But obviously where they're going, they're probably going to have to be looking into getting a new home.
An expensive one.
Yeah. What other scenarios are out there where people might really not have much of a choice in how they go about things?
I would say death. So losing a spouse where they can't financially afford the payment on the existing home that they live in, needing to downsize, basically. That's a big one.
FHA. So if you started with an FHA loan, FHA, if you had the loan after, what year was it? 2013. I think after that, they require private mortgage insurance on your loan for the life of the loan. So I have a lot of people that want to refinance if that mortgage insurance is still, they still have it on there. So, and they have enough equity now to where if we were to refinance it, it would remove mortgage insurance. It would, re-amortize their payment. And it's very specific to their situation. So in those, I think that's why we say it's a kind of a case by case.
Yeah.
And we would look at the numbers and kind of run those numbers for them and see if that makes sense to remove the mortgage insurance and then see what the rate environment is like right now and how that would affect their payments. So I get a lot of that questions on the mortgage insurance just because people are, how long am I going to pay for this? Well, until you refinance that loan. So
okay.
Another one I thought of, growing families. There's only so much room in an existing house. So that's one I've dealt with recently with purchases where people just cannot fit any more children in their existing home. It's time to upgrade.
Yeah, bunk beds only get you so far.
Right.
I grew up sharing a room with my younger brother. And
I've seen the 3 stacks. So they're getting
luckily we never had to get there. The other one that I thought about would be a potential medical issue where somebody suddenly doesn't want stairs in their home or can't do stairs anymore. Finding those situations where maybe they need to look into the current rates and whatnot.
There's so many scenarios that, we can go back and kind of like all the ones that we've dealt with, but that's a big one, the medical one, especially as you have older parents that are, not maybe keeping up with the property the way they should, or they can't anymore. I've had where the son wants to take over the home and because the parents are now going into a nursing home. And so, in those cases, it's like, how do the children take on that property when the parents, are wanting out or.
That's another one with even just combining residents. I've seen more requests for like what's called a ADU or basically like a mother-in-law suite to be able to build homes that have space to be able to move parents on and be able to combine that income. That's something that I have had the question a lot about, where people are thinking about ways to be able to live more comfortably by combining incomes, basically. And it's becoming a little more flexible. I know out in the Pasco area, they've removed some limitations on the size of the mother-in-law suites that you can build.
Now, just to clarify, the mother-in-law suite, as it's kind of informally known, is a separate building on the property. It's not actually attached to the main residence. Correct. So it's almost like a tiny home or a mini apartment that's just detached from the rest of the house.
Like, and some of those homes have like a separate like shed or like a separate garage, and they turn it into a dwelling unit.
Mm-hmm.
Well, and they are building ones now that are combined, because the different cities have different rules on whether they are allowed or not. And again, they are lifting some of those requirements, but I have seen some that have been built where the main house has like a hallway that attaches the other in-law suite, basically, and they have a full at which
point it officially counts as one building as opposed to multiple. I'm sure that comes down to zoning requirements as well with cities, which is probably where a lot of those changes are coming from that you're talking about.
That's definitely one of those things that people will ask us those questions. I'm only aware of it because I've helped people with the loan side of it, but you definitely want to check with the city that you live in to find out what the requirements are for where you live.
If I'm looking at trying to get in and doing this, and I've been planning ahead because I have done this podcast long enough to know that planning ahead is always a good move. I'm going to come in and make an appointment with a loan officer, and we're going to calculate a bunch of stuff. That's what we've been talking about this whole time. What should I be looking at as my first meeting with you? Am I supposed to show up with nothing? We're going to have a conversation and you're going to tell me what I need, or should I be showing up with like the last 10 years of my bank records, income?
Not that far.
So what is that first appointment going to look like?
I would say the keyword there, appointment. A lot of times we get people who assume that it's a quick conversation and they can just stop by and be able to get some of those questions answered. But we really do want to schedule time so that we have given you the list of documents that we need so that we can get the full picture of what your financial situation is. And then we have enough time to be able to go through the details, because there has been times where I have been rushed through a process and maybe we didn't really fully cover closing costs because we kind of generally went over it, but they didn't understand what the details were. And once they got into the process, it was a whole lot more overwhelming for them. And so it's a good thing to make sure that you have time. And then 2 years, W-2s, 2 years tax returns, 30 days pay stubs, typically is the income side of things that we're looking for. And then assets. What money do you have available for this transaction? So typically, I mean, 2 months bank statements or most recent quarterly statements for retirement accounts is what
you mentioned. You mentioned time, making sure there's enough time for this appointment. Do I need to block off like a half day for this, or are we talking 15 an hour? Okay.
I say for the first appointment, at least an hour, because one thing does lead to another, and your conversations can go an hour and a half. And so, by an hour and a half, I mean, we're all tired of talking, but but I mean, we can keep going because that's what we're there for. But I think if you block out an hour, you can come to an appointment not bringing anything. If you just want to ask questions, we can do that. But if you want a more effective and, make the most of your time with us, then the best way would be to bring those documents in. 2 years tax returns, 2 years W-2s, 1 month pay stubs, 2 months bank statements. And, if you're self-employed, that adds a little bit, maybe another document there. If you pay child support, if you receive alimony, if you receive child support, if you are using any income other than a W-2 income, then that could add some, additional documents that we would need.
So most likely what I'm going to want to do is get on the phone with you first and write down a list of things that I should probably gather up. Quick phone call.
I send an email to the member I ask ask what kind of incomes they're receiving, what kind of liabilities they have, and I will send them a quick list of things that
That's
they're going to
good because my handwriting is terrible and I'm not going to be able to read half of the things that I write down during a phone call like that anyways.
We all work a little bit different. We can do email, we can text you that list. You can pick it up at any bank, or you can even go online. I think it has somewhere on HAPO there. I'm sure there's a list of documents, but the best way would be just call or swing by. We'll give you a list. We'll make an appointment, come in, we'll sit down, we'll look at your situation, specifically your numbers. If you're ready to, to do the app, we can do the app right there. We can text you the app. We can email you the app.
Okay.
So you can do it online. So there's so many options.
So our previous conversation on this, I had heard 6 months was a pretty good window for somebody that wanted to do this to come in and make that first appointment.
Absolutely.
Now, if I'm ready to do the application, we can do it like right then?
Right then.
Okay.
Yeah.
The thing with the application is that people need to understand that we do need to pull credit in order to be able to look at the financial picture. We get a lot of times where people are wanting to shop around and they just want to know what rate we can give them. And really, I can give you a rate off of our website, but it doesn't mean that's what you're going to qualify for based off of your situation. So the best way to get the most accurate information is for us to be able to do a full application, look at the debt to income ratio, and we can take a look and see what obstacles we're going to run into that we need to have a conversation about.
And then be able to plan for.
Correct. Because if they didn't mention child support or they didn't mention one of these little things that end up showing up on the credit report, that can kill the amount that you qualify for. So you get excited about going to shop in that $400,000 range, that can really quickly change on a mortgage. And with all of those different factors that Carol mentioned earlier, mortgage insurance, property taxes, homeowners insurance, with all of those different layers, without us putting it into the system to be able to really look at the big picture, it is really hard to give. We can give generalized information, but it's not going to help you. I mean, you want to know what your scenario
is.
Because,
a lot of times Credit Karma might tell you your credit score is 800 and it comes back at
630. Yep.
Or, it could be that I have had people who tell me my credit score is like 640 and it comes back at 720.
That's more common, actually. Yeah.
So it goes both ways. We really want to be able to give you the best information possible. And in order to do that, we would have to look at the whole picture, We
end up going and spending like double the time if we're not looking at the application. We're going in 12 different directions, giving you all of these what if scenarios that are just going to cloud the picture for you when it is so much easier for us to be able to target exactly what your situation is with the application.
And then, of course, after walking away with that information, now I can go start to look at either the project of building the mother-in-law suite, or start picking out the neighborhoods that I want to start looking at houses in, because I'm going to have a much better idea of what I qualify for. And actually probably, what about, as I'm thinking about this, pre-approvals, I believe that your real estate agent's going to love you for that.
Yes, they are. They're going to be so happy if you show up with that pre-approval letter. They're going to be like, wow. Yeah.
I mean,
yeah. And, the pre-approvals that we do are good for 90 days. So we give you one. It has an expiration date on there, but it's good for 3 months. So
I don't have to go shopping this weekend and make that final choice right out of the gate.
And even at the 3-month mark, if you're still looking, all we have to do is refresh the application. We already have it.
Everything's still good.
Update your information and then pull credit again, and it's good for another 3 months.
And that's a big thing right there. So they came in, let's say today, to be able to do an application. 90 days from now, the rates may look completely different. Right. So what they qualified for today may change by $50,000 when we go 90 days down the road. So it's something we'll reevaluate at that point and just make sure that we got the most up-to-date information for them and the most accurate approval amount. If the rates go in the opposite direction and they go up, that absolutely could decrease the amount that they qualify for. So that's,
and of course, if they go down, then all of a sudden you might be able to look at that house with a pool.
Exactly.
Can I go down a rabbit hole on rate shopping? So here's my what is it, soapbox? Yeah. So I have, if you're out there rate shopping, here's a tip I'm going to give you. Make sure that you're getting this, rate shopping on the same day because rates change. They could change daily. They can change hour by hour. They change often. And so you could check a rate with one lender today, check another rate tomorrow, and check another rate next week. You're going to have you're not comparing apples with apples.
Okay.
So
now you got a picture of HAPO from the first lender where the rates were higher.
exactly.
And we have the same rate that other lender did because you didn't come back and check back in with us.
Make sure that you get your fees sheet. So ask for a loan estimate, ask for a itemized fee worksheet, whatever they call it. They call it different things at different places, but you want to know what the fees are for that specific loan that you're asking about, because you can come to me and tell me, oh, so-and-so is offering me a 6% and you're telling me you're at 7%. But what you're not telling me is that they're charging you $7,000 to get you to that 6%. You know what I mean?
They had an FHA loan and not a conventional
Correct.
loan. And it means that they're paying more in mortgage insurance because
say,
they're getting a different type of loan. So without those details, there can be a lot of things that have caused those things to be as different as they are on those
and
two
that's
documents.
huge right now. Everybody is about rate shopping. And so they think that being able to go online, calling different lenders is it's that easy. Well, it's not that easy. Like, we really have to know what your credit score is. Like Britany was saying, there's so much detail into getting that pre-approval done for you that, I could quote you a rate, but if you want to be able to compare and for those comparisons to be equal, you have to be able to give us all that information.
That's a big thing with credit reports. So you have 2 weeks to pull your credit as many times as you need to with all the different lenders, where it only counts as one inquiry on your credit report. So if you are going to be shopping around, which HAPO is very competitive on our interest rates and our fees. And a lot of times what we'll find is when we're comparing those loan estimates next to each other, what will happen is our origination fee may be a little bit higher, but they have a processing fee that is double the amount of ours. And typically when we're looking at it, HAPO is either beating or we're going to be very competitive to what the other lenders are. And we're always happy to match, taking a look. Sorry. We are always happy to take a look at matching interest rates and terms of what other lenders are offering.
And it's, I think a big part of our job is educating our members because, they might not know that origination fee, that processing fee, that administrative fee, that's all the same thing, but they're called different things. So it may look like a different line item, and when you combine them, it's still, a lot higher than what we would charge on one line item. So, it's just one of those things that it's sometimes challenging because I don't think that a lot of people understand how that works. When you call in to ask for a rate.
Well, just the buy down that she mentioned, people really don't understand that part of it. And it's very deceiving for first time home buyers, for lenders to show an interest rate at 6.5%, but the little fine print at the bottom says that costs you 2% in origination cost to be able to get that interest rate. For me, with my loans, I'm going to quote them the interest rate that costs them no additional money at closing.
Exactly.
So it's going to look a little bit higher a lot of times, but
and then maybe have the conversation that says, and if you want to look at this,
correct,
this is what it would look
most
like.
Most of the time, people are not. They don't have a ton of extra money sitting aside to be able to throw at an interest rate. And it may be more beneficial for them to go ahead with the higher rate that's available right now, save that money in their pocket, and then look at refinancing when those rates go down and put that $7,500 for that rate buy down towards the closing costs when it comes time to refinance down the road.
Because then you're not having to pull that extra money from somewhere else that maybe you weren't planning for.
Correct.
Sorry, I was attempting not to burp into the microphone.
We'll keep that in.
Yeah. Perfect. So is there anything else that you ladies want to talk about today as far as our members go, as far as our listeners are concerned? Any more heads up or last minute pieces of advice?
Well, like Brittany had said earlier, we are going into, the spring. We are in spring. And so we're going into the buying season where, things get a little bit more busy with rate shopping and trying to get ready to buy a home. And for those that are selling, for them to get their homes listed and, on the market. So, if you're interested and you want to know more about what you can qualify for, what your options are, the best way is to just reach out to us or to a loan officer and have that conversation, because everybody's situation is so different. So, that's what we're there for. We'll listen to it and analyze your situation and then give you that feedback that you probably didn't know you needed.
Just like Carol said, when you are getting serious about that process, you need to be serious about having those. When we ask you for certain documents when you're coming in for that appointment, it is important that you bring all of those things with you, because a lot of people don't understand the impact of not having one of those items can stop us from being able to run your application through underwriting and getting an official pre-approval. So that is one of those things. If you are serious, make sure that you've gotten everything together that we have on the list. Do the little bit of extra work to get that copy from whoever you need.
Because otherwise it's going to be another meeting to bring in that.
Correct.
And then the next one. And
yes,
it ends up feeling like a bring me another rock type of a game.
Right.
And it's much more efficient for them and us. And people don't realize that. They a lot of time assume it's just us that's keeping the process held up. But it really is. If you bring everything we asked for at the beginning, we can get you a pre-approval very quickly.
All right.
And one thing I'll say for HAPO is that we have local underwriters, we have local processors, we have local management. So it's really easy to get, not easy, but it's quick to get your application through and pre-approved. So it's very efficient, the process that we have down. So.
All right.
Yeah.
Well, ladies, thank you very much for coming and chatting with me on the podcast today. For those of you listening, if you want, we do have the ability to schedule an appointment on hapo.org. Go out there under the contact menu. I believe there is the ability to schedule an appointment. You can go take a look at all sorts of information on HAPO's website under loans in the mortgage section, where you can find out some more about some of the products that are offered, and then schedule yourself an appointment, come in, have the conversation with a loan officer, learn about what it is that you need to bring in if you've got a plan, if you're thinking that you might be in the market soon. Never hurts to come in and have that first conversation. Nothing says that you have to go any further than that. Learning all about what your situation is and what you can do and what your options are, you'll be better set to make a quality financial decision with your current situation. So until next time, this has been Dollars and Cents, HAPO Community Credit Union's Financial Literacy Podcast. Till next time.